All right. Okay, November 22nd, 2022. We're going to talk briefly about the bank reconciliation. Okay, because we only have about 15 minutes. All right. So bank reconciliation. This is what you're going to be creating. The bank reconciliation is where you take basically make two statements, one for the bank and one for your books. We call it the books, and that's essentially your cash account, your T account for cash. Okay. When you get to the bottom, they should be equal. If they're equal, you have reconciled the bank account. Okay. So we get the bank statement. Let's see if we can make this bigger. Starting with the bank, we start with the bank statement, and we take the ending balance from there. We add two things, we subtract two things, and we get an adjusted total. And I'll walk through what those are. We compare that to what's on our books. So we go out to the T account and we say, what's in the T account, general ledger, another name for that whole group of accounts and their balances. What's the balance there? We put the balance in there. We add a couple things, we subtract three things, and we come up with the adjusted balance for the books. If those things are equal, we have reconciled the bank account. Okay. And we do this as companies. We do this, some of us do this as individuals, because we want to know if there's any errors in the bank. And I have to tell you, the bank makes very, very few errors now. In the old days, they used to make a lot, but not so much. But the place for errors that is more a problem is on the books. And so this helps us. It is, again, like a check and balance. Is the cash account correct? And then we can fix it if it's not. Okay.
Yeah.
So let's go back to this. Okay. So I'm going to skip the accounting for cash and just jump ahead to BankRecon. And you can. All right. So why do companies use a bank? Most companies use a bank, although I guess you can use Bitcoin if you don't want to go through the banks. I'm not liking what I'm seeing on Bitcoin these days, but anyway. But it does it keeps a double record, and you don't want to have a lot of cash on hand anyway, because that again becomes an opportunity, a temptation for people to steal.
Yeah.
It really does. And so companies cannot only deal in cash. It's just too risky. And the bank statement gives you a record of all the increases to cash and all the decreases to cash. So take a minute and really think about, here's the company. We do the company's books. Okay. Here's the upstream. There are the suppliers or vendors or employees, people the company pays money to.
Yeah.
Here are the customers. Customers pay the company money. Okay.
Yeah.
So when a company pays money to the suppliers, I'm showing that in red or pink. When a company receives money, I'm showing that in green. Okay. Companies pay with checks. They can also use electronic transfers, but essentially it's cash goes down. That's a credit to cash. When a customer pays us, it's a debit to cash. Okay. So company owes a supplier money. The company tracks all this in accounts payable or salaries payable for employees. Customer owes the company money. The company tracks this in accounts receivable. Cash goes up with debits from customer payments. Cash goes down with payments to suppliers or employees. Okay.
Yeah.
So when the company pays a bill to a supplier, say for $29.50, this reduces or credits the cash account. Okay. And it would debit the accounts payable account. Okay. So Chapter 6 didn't have any journal entries. Chapter 7 has just like a handful, but it really needs you to be aware of the impact of debit or credit on the cash account, on accounts payable, on accounts receivable. When we get money in, the customer pays us like $20. This increases the cash account. We debit cash, and we would credit accounts receivable. Okay, oops. Yeah, okay. The company's records are, so the company records are the balance in the cash account. We also call that the books. If I say, what's on the books? I'm talking about cash. So in the previous example, the cash with all those, the add and the subtract, the company balance is 32070. And you can see that here, 32070.
Yeah.
Okay. So using a bank, company can't deal in cash. It's too risky. All right. So all month long, the company is writing checks to suppliers. It's paying its bills.
Mm.
The way companies' accounting departments work is checks are immediately deducted from the company's cash balance. But then the actual physical check is mailed to suppliers.
Yeah.
So this can create a timing issue between the company's books and the bank books.
Yeah.
Because it takes time for the check to get to the supplier, and then the supplier maybe cashes the check the same day, or maybe it waits a day or two. Okay, so that would be timing issues. And that's part of the reason we do the BankRecon. Okay. Same deal. All month long, customers are sending checks to the company to pay their bills.
Yeah.
Company receives the checks. Customers are immediately added to the books. Checks are added to the books. Company's cash balance goes up. And then maybe they put the checks all in the safe, and maybe they only go to the bank every 3 days. And then they get to the bank, and then they clear the bank, but there's timing issues. Okay. And that's what, so all this checks coming in, checks going out, all of that is part of the bank reconciliation. Okay. So all the checks paid, all the checks received, any other deductions made by the bank, any other additions made by the bank. So once a month, the bank sends the company a bank statement, and it shows it all, but it's only from the point of view of the bank. The bank doesn't know what's going on the company's T account. They just know what has cleared the bank. So here's one example of a bank statement. Okay. So I'm just putting this as a comment over here. The book balance, the balance in the T account is 532269. You won't see that on this bank statement. That's on the company's records. The bank statement tells you what's cleared the bank and what's the ending balance, 648895. Here it is, ending balance, 648895. And then up here, super busy, you've got a list of all the deposits, money increasing the bank account. You've got a list of all the checks going out. That's deductions from the bank account. And then this last column is the daily balance. And you can see again, at the end of the month, 648895. So we've got it here and we've got it down here. Okay. So all of these are deposits or something called a CM or credit memo. All of these are check numbers. Okay. Except we've got some other deductions, a return check, a debit memo, and a service charge. And where it says RT, most textbooks refer to that as NSF, not sufficient funds. Okay. So we'll talk about that in a minute. So here's the list of checks, and they're pretty much in order, but you can see there's a couple gaps here. 167 is not there. 168 is not there. And then we need to check the books and see if there's checks that were issued that haven't been cashed yet. So we're going to work with these categories. We're not going to worry about the balance, except we need that ending balance. Okay. So using the bank statement, we'll start working on the bank reconciliation. Okay. So the bank balance rarely equals what's on the company books, the company T account, because of timing issues. And we talked about if the company paid a supplier, but the supplier hasn't received the check yet, it's still in the mail, or the supplier hasn't deposited the check yet, it's already been deducted from the company books, but not from the bank statement. So there's a name for this. There's a name for these checks. They're called outstanding checks. they're still outstanding. They have not been cleared.
So they're cleared when the bank gets them.
Exactly, yeah. And in this case, the company's books would be lower than what the bank says because the bank hasn't recorded the deduction yet. So it's like sometimes you look up your bank account and you're like, oh, I can do that. I've got money in my account. Well, you forgot you wrote these checks and they haven't cleared yet. So you have to be careful of that. Okay. How about the other side? The company received a payment from a customer, but they haven't taken it to the bank yet, but they've already recorded it on the T account. In this case, that check is called a deposit in transit. And in this case, the company's books would be higher than what the bank says because the bank hasn't received the check yet, the deposit yet. So in both of these, we've got checks. We've got checks going to suppliers and we've got checks coming in from customers. So you really want to make sure as you're reading problems to keep it straight. Is it a supplier? Is it a customer? Okay. There are other issues that come up where the bank has collected a note receivable for the company. In that case, the bank statement will be higher than the books because the company hasn't recorded it yet. And there's usually interest revenue or a bank service charge, and that'll be recorded on the bank statement. So the company needs to record that also. Okay. And banks charge a monthly service charge, and that'll show up on the bank statement. And the company has to make sure to do a journal entry and deduct that from the cash account. All right. Other timing issues. RT was in that bank statement, but we usually say not sufficient funds. And this is a icky situation where a customer pays the company makes the journal entry, they increase cash, they debit cash, they credit accounts receivable, they put the money in the bank, and then when the customer's bank tries to pay the other bank, there's not enough money. And so we say that check bounced back. And so the bank the bank reverses the deposit. And so they take the money out. And then the company has to take the money out of they have to reverse that deposit and fix it.
And
so
return it back to
subtract the CAD and put it back on accounts receivable because it wasn't collected. And then you go back to the customer and they say, oh, I'm so sorry. I'll write you another check. And you hope it doesn't bounce. Okay.
Yeah. So I always heard that the check bounced. The check bounced. I never understood what that meant.
So here is, and we're going to finish up with the next slide. You start with a balance per bank. You add any deposits in transit. You subtract any outstanding checks. So both of these, the bank hasn't seen them yet. They're still out there. They're not recorded by the bank, but they are recorded by the company. So everything in this column has already been recorded by the company, but not by the bank. So it's deposits in transit and minus outstanding check, and you get the adjusted balance. Then the company looks at their books and they pick up the bank statement and they say, is there anything on the bank statement that we haven't recorded yet? For example, did the bank collect a note receivable? We need to make that journal entry. Were there any disbursements by the bank? We're going to subtract those. And then hopefully these two are equal. So this is an example of a bank reconciliation. You can see at the bottom, they're equal. So that's happy news. And you can see at the top, they're different numbers. Okay. So let's start with the bank statement. There were $225 deposits in transit. That's going to only go on the bank side. And we have 4 outstanding checks that haven't gotten to the bank yet. Going to subtract those. 6,488.95 plus 225 plus these 4 checks, 1141.66 equals 5,572.29. Then we start with what we know, and the problem has to tell you what the balance is on the books. And then how do we get these 4 numbers? We go back to the bank statement and we say, look under deposits. We recognize all these deposits, but we don't recognize this one. This is a credit memo. And we're going to add that to the books. And then under checks going out, we're going to subtract these three. And that's what we did on the bank statement. We subtracted those three. And when we do that, we get an adjusted balance per book. Okay. And there's more to learn on this, Hamza, but I want to stop here. These 4 items, anything on the book side, you have to follow up with a journal entry. Okay. So the problem has to tell you more details about what this is. Okay. So the journal entry on this one, they actually said checks coming in are added to the company books, but not yet recorded by the bank. That's the bank side. Now let's do the company side. So we say, oh, look, $300 was collected. And the problem has to tell you, oh, this is a note receivable. It was paid in full. And the bank charged a $5 collection fee. So under the add column, you're going to add $300. Under the subtract area, you're going to subtract $5. Okay.
Okay.
This is going to reduce note receivable. But when the bank makes a charge, we're going to use a new account called service charge expense. Okay. So this one is a debit to cash and a credit to note receivable. This one is going to be a credit to cash because we're reducing it.
Yeah.
And a debit to charge expense. Yeah. Other charges, we had a bounce check. We're going to deduct. All of these are going to be credits to cash. But if a check comes back, it has to go debit to accounts receivable. We're putting it back on accounts receivable and credit to cash. Okay.
Yeah.
This is another service charge. Debit service charge expense, credit cash. Okay. And then here's the journal entries. You can do debit accounts receivable, credit cash. Oh, sorry, here's the first one. So we collected, we reduced notes receivable by $300. The net effect of these was debit 300 minus 5, so we made it 295, and then we're charging service charge expense. This bounce check we're putting back on the books. We'll have to try and collect that. This is the monthly service charge expense. We're reducing cash. And after we make all these journal entries and post them, our ending balance should be what it says here. Okay. And that's the bank reconciliation in a really short time. And I'm going to stop the recording.